Welcome back. You're watching Stockwatch with me, Simon Brown, and joining me to take your stock-related questions tonight, Ricus Reeders, PSG, Hole-in-One, Ruimsig, and Graeme Körner from the Körner Perspective. Be sure to send your questions. Email us, stockwatch@bdtv.co.za, or via SMS 41392, or on X using hashtag Stockwatch. Gents, thanks for joining us today. I want to kick off Motley Fool. I'm not sure how much you're both aware of it. They're a site in the US, Australia, and I think China. They've got subscription services. They do podcasts. They had a tweet on the weekend of their 5 favorite US small caps, and Karooooo was on that list. Ricus, Karooooo, is it a stock on your list? I mean, they're according to them, they're small cap because they're under $5 billion, which of course is bigger than Mr. Price, but what the heck. Ricus, Karooooo?
Yeah, it's interesting. I wish it was a little bit more tradable because that price can be quite volatile, and that always affects not necessarily my perception of what I should invest in, but my client's perspective. They don't like volatility. But as a business, last set of results, the annuity income keeps on ticking over. I think it's a difficult market to participate in, but they've got lots of room for growth. Plus, obviously, they've got the backstop of their South African business. So, and compared, if you want to call them an IT or IT-related stock, compared to the valuations you get for some of the other players in the IT-related sector, it's obviously fairly cheap.
Yeah, it's not on a 3-digit PE is what you're politely alluding to. Graeme, Karooooo?
Yeah, I think what Ricus was saying is right. My sense is that although, telematics, because I think that's really what it is, and it's not just watching cars, there's, I think, other outlets, which is what's quite exciting. As logistics and supply chains become more and more technical. But I do think it's quite a competitive landscape. And as Ricus says, it doesn't quite trade by appointment. But I mean, the gap from 827 on the bid to 838 is, things that we just don't like to see. Although you'd argue, if you like the story, just sit on the bid, don't take the offer. And that way you'll avoid some of that, short-term volatility. Yeah, I mean, a 37 multiple is maybe cheap compared to a NASDAQ 45, but it's not ridiculously cheap. So I think the narrative is good. I think the story is good. As Ricus said, good installed base, good annuity flows. Obviously pivoted internationally very successfully. But, for me, Simon, when you're on approaching a 40 PE, you need to have high visibility of sort of 25-30% earnings growth for a couple of years to unwind that to a sensible number. And I'm not sure you'll get it. I think but Motley Fool are quite contrarian and they're not scared. And I think that's the nature of the model. But, we box in a slightly different market, or I do anyway. And I think Ricus says we don't like volatility. I think him and I, and you as well, understand that volatility goes with the with the territory, because without it, you just can't get exposure to growth assets. But generally, we would right now be looking for slightly higher visibility. If you can get 15-20% earnings growth on a 10 multiple, I'd rather do that than look for 15 on a 37. But being US based, obviously will help the valuation.
Yeah, and the US have I still, every time I look at Costco on a 50 PE, it makes my eyes hurt. I mean, a great business, but 50 PE. So Graeme, let's stay with you. Let's look at Absa. Question coming through. Market liked the update. Everyone always says cheapest of the banks. Is it time rather to have a look at Absa? I mean, there's your low multiple and, double digit, but low double digit growth at the same time.
Yeah. I mean, I've called Absa, I don't know how many times over the last year or 18 months. I think the hypothesis there is they've had some challenges, obviously more exposed to the middle income market. So, higher interest rates, disposable income under pressure, none of that helped. So you saw the impairments. So producing pretty much the worst of the big four in terms of operation. But equally, when the interest rate cycle turns, and it's already done, you will see the reversal of those provisions. And, it's at a fairly deep discount to somebody like FirstRand, which is a really good business, but, I think the story here is when the tide comes in, it's going to lift all the boats, but it'll probably lift those that are on the lower multiples more. So, the thing's gapped up quite nicely. It's been probably one of the most unloved stories, not just in 24, but for quite a long time. If you think what they're likely to deliver for December 24, and then what the outlook is for, more importantly, for 25, you're still buying this thing on probably a forward of 7 and a bit, and a dividend yield of over 7. So you're getting a better dividend yield for getting DWT for a second than you would be getting, by having your money on a deposit with them. So, those are odds I can live with, but it has sort of gapped up a little bit post the update.
Yeah, Ricus, your views on Absa? It certainly did jump. Well, I think the update was just after the close last week, and then the next day it jumped quite aggressively.
Yeah, and as Graeme said, he's been picking it for a very long time and for very good reasons, in that it was unloved, and all it had to do was produce reasonable results, which it did after a series of disappointing results, which gave you a market re-rating. So it's not as if it's turned into a stellar business. It's just that the results were less bad than expected, and is now getting to be somewhat decent. Going forward, again, if I agree with Graeme, you can still get, or it's still in a value position versus the other banks, and the outlook or the sentiment might improve over the next 6 to 12 months, and you'll see a further increase in that price. But I think that easy money has been made with this update. So now the choice is, do you want to buy a discount into a business that is not as well rated or is not as well run as your standard banks or first round, and live with that and hopefully have another share price increase? Or would you rather be a little bit less risky and say, well, that whole sector is still looking positive, but I'm going to play it a little bit more safe by sticking to companies that has a better track record management-wise when compared to Absa over the past number of years.
Yeah, and their revolving CEO problem. Ricus, let's stay with you. Question coming through around Telkom. He has a chart that the 1-year version did nothing and then suddenly took off to the races. Question is it too late to buy Telkom? Is this still a good-looking investment? Ricus, your takes on Telkom. The end of that chart is doing great guns, but as you zoom out, maybe less so.
Well, yeah, just Graeme, apologies, it's technical analysis again, but just from that perspective, one doesn't see this kind of move very often, and people often say, wow, it's almost straight up. But because the size of the move plus the volume accompanying it could actually spike up, another 15 to 20% easily. That's not a prediction. It is just a possibility, taking that. But from the ground up, and I think Graeme might agree with me, that the company has certainly been turned around from where they were. They're the biggest wire or fiber service provider in South Africa. They're getting rid of their legacy business, and they don't have the extra baggage of trying to make money in Nigeria or wherever. So a far more stable environment for their business. And I think that's part of the price jump and the re-rating that we've seen.
Yeah, Graeme, it's no longer the Telkom of copper cables. It's now very much a mobile / fiber to the home. Your sense on Telkom, notwithstanding a really good run recently?
Yeah, I remember years ago, a colleague walking in and saying, "What you doing?" And I said, "I'm looking at Telkom's balance sheet." And he laughed. He said, "Why would you ever want to buy that?" And I said, "Well, there's a property portfolio and there's underlying assets, and certain businesses generate cash and their masts and all sorts of things." So I think it's one of those where there is inherent value. My problem, I think in a way, Ricus said it, that they may not have the distractions of Nigeria and the opportunities, etc. But at its core, they are still a voice in the data business, and rates are falling, and I think it's going to affect the entire sector. So I think there are opportunities within the portfolio. There's probably value, but it's not a classic NAV, because I think the sands are shifting in that industry. And I would argue somebody like Rain is probably messing the party up for everybody else. So, while I think the story is looking good and there's underlying value and there's optionality, the core traditional data business does not excite me. I just think it's going to become increasingly competitive. And, it wasn't long ago, Elon Musk was talking to Donald Trump, and they're talking about Starlink. That's been a game changer in certain markets, and it could be in South Africa as well. So, you sort of, you don't see these things, these sort of black swan events, until they appear. So it's a long way of saying I don't really know. I think it's cheap, and there's probably quite a lot of upside, but it comes with sufficient health warnings to probably cause me to say I'll just carry on looking at it and not do anything and wouldn't buy it.
No, fair shout on that. Question coming through, please help me. Mr. Price, I've almost doubled the value since I bought it. Should I hold on? Graeme, would you be holding Mr. Price after a 100% return at this point in the year? It has been a stellar. I think over the last 12 months it's up some 80-odd% excluding dividends.
Yes, my problem is that Mr. Price, for many, many years, they were in a league of their own. They understood the value segment, while everybody else was sort of trying to play in the higher LSMs. They just got on with it, rolled out stores, brought new offerings, if you want to call them, in terms of home and sport and so forth, to market. But I think it's become a lot more competitive. You've seen the likes of Pepkor obviously moving into there. The management team that we rate very, very highly, which is TFG, obviously into Jet and others. So I think the competitive landscape is a lot more competitive, but I do think that they've done very well. Arguably, TFG has done as well over the last year. Gone from $80 to call it 170 or thereabouts. So it's almost as though the markets got very excited. The multiples are still not demanding. But, whenever I'm asked the question, well, should I sell? The question is, well, why did you buy it in the first place? Normally when things double, it either tells you, which is, okay, I'll talk to TFG, but you can, I suppose, take the analogy through to Mr. Price. When something doubles, it probably means that it was ridiculously cheap, and the market has suddenly fallen in love with it and is happy to suddenly pay a lot more for the units of growth. But I do think that as a collective, the value market is still going to face challenges. We can go into the Chinese import market, where again, some of our TFGs obviously positioned themselves quite well. But my point is, if the viewer bought it because they thought it was oversold, looking too cheap, wanted to make a quick buck, then you'd probably say, well, gee, because it's probably not going to go up another 100% or even another 30%. Then you would take your money and bank it. But if you bought into the fact that they are really good at what they do, and they probably understand value better than everybody else, and that even though maybe they lost their way a little while ago, they seem to be back on track, then why sell it unless you haven't got a lot of capital and you found something else that you feel is more compelling.
Yeah, but I like the point.
I've given you a nothing answer.
Yeah, no, but it comes back to, why did you buy it? And that's always my question. Why did I buy it? Ricus, Mr. Price up 100-odd% in the year. Would you take the money and run?
No, but what Graeme said just before the break, unless you find something else that that you want to put your money in, that's going to have a similar type of price appreciation than that Mr. Price had. At the moment, the price is moving from the left bottom corner to the right top. It's an uptrend. There's, just because you think it's expensive doesn't mean the market thinks it's expensive. Stay with what the market tells you. The trend is solid. I think it's expensive. I wouldn't necessarily buy into it right now, but if you've got it, ride it. And if it starts turning or you find something else, then sell some or sell all, or make that individual decision.
Yeah, no, I like that. And let's stay with you, Ricus. Brait question coming through. Brait unbundling. Don't much like New Look, but do like Virgin Active. Is Brait worth a look at current levels?
I think Graeme knows more about than I do. Certainly Virgin surprised me. Obviously people are going back to the gym. Premier has been doing well. New Look not so well. And that's not necessarily only because of New Look, but UK consumers are under pressure. So you're going to buy good with bad.
Yeah.
If you focus on the good, go for Virgin Premier. Things that hold you back, obviously, near look.
Graeme, Brait?
Yeah, I think Virgin Active represents, if memory serves, about 80% of the underlying value. New Look, I wouldn't call it a rounding error. It's still, 800 odd million. So it's a reasonable number. But I think the plan is to offload that position. Hopefully they can do that. Obviously it's been a difficult trading environment for some time. But I think Premier will just be monetized. It's trading well, so you can almost take that NAV, I'd say, and bank it. And then, I like the Virgin Active story. Back over 1 million subscribers, back to before, better than subscriber numbers than before 2019. But I think what they've got in the leadership in Dean is somebody who understands that it's not just the numbers, it's how you actually monetize it, how you drive the revenue per user, how you drive engagements. They tempt you with a smoothie, but get you to buy 2 or 3 along the journey. So I think they're moving towards more of an integrated wellness play, and I think that will work. So my sense is, if they carry on, if Virgin Active carries on like this, which I think they should do, remembering places like Italy are trading very, very well, and I think the UK has been a bit of an Achilles heel, but that I think too is going to get a little bit more attention and capital, like South Africa. And when all of this is said and done, fast track 24 months, and suddenly a listing's on the cards, and all the smarty pants that were in the Ethos investor call a year and a half ago were saying you'll never be able to list Virgin Active, and you're delusional. Suddenly it's realistic. So I think there's a good story there. Obviously, the rights issue changed the balance sheet structure, the risk considerably, diluted the NAV a lot, but it's still at quite a big discount if you believe that Virgin Active NAV. So I think there's a lot to come, but you have to recognize that the share price has doubled. So do you now sort of work on the old buy the rumor, sell the fact, and maybe wait and just see what comes out of it? Yeah.
I take a point. No, there's good NAV there, but NAV has caught me before, although sometimes it does play out beautifully. Graeme, Mpact, which of course they've got the whole Caxton with a just under 35% stake, since at some point they make an offer. Is Mpact attractive at current levels?
I don't really have a good feel for it. I think the packaging industry in South Africa is kind of at the mercy of a handful of really big customers generally. If I compare Mpact, for example, with a company that I wouldn't say recently fell in love with, but Mondi, for example, after the disappointing update, I would argue that Mondi has got far more petrol in the tank. I'm not talking about corporate action. I'm just talking about the markets they operate, the products that they work in, being more of an e-commerce play, for example. I would personally rather look at something like Mondi than Mpact. If you're betting on corporate action, Simon, you and I both got the T-shirt where we thought it was going to happen and it didn't, and the other way around. And sometimes it hurts and sometimes it doesn't work out. So I would rather not play that and say I'll just go with the fundamentals. And I think Mondi's looking quite well placed for the next few years.
Ricus, Mpact, or would you also prefer a Mondi?
I also prefer Mondi. I mean, it's my story is pretty, I think, simple. You've got Mpact and their market is South Africa. You've got Mondi and their market is Europe and possibly the rest of the world. So there's just more opportunity for Mondi, and Mondi is a very well-run company, I believe. That's if you want to be in packaging. Packaging is difficult. It's cyclical. You've got to be very good at your game, as Mondi is, and even then, things can go wrong, as Graeme alluded to. But I think just on the prospects and the size of the market you're dealing with, I'd rather prefer Mondi as well at the correct time, which I think at the moment is probably not quite there yet.
Okay, no, take your point. Question coming through, Brian, for Boxer. And question is, I like it. What's a fair price to pay for it, or should I just pay the current market price? Ricus, would you be looking to put sneaky bids in on Boxer, or is the current 64-ish a good price for Boxer, or perhaps a stock you just don't even like?
Yeah, no, I mean it's interesting. I think it's got it's got great plans and great expansion possibilities and great competition against it as well. Obviously, the initial chaos or optimism or overdriven sentiment have subsided a little bit by now, and we are sitting at about the 64 rand price, and I think that's indicative of the market saying, okay, the listing is out of the way. Let's see what happens. And I think that's my attitude as well. Let's see what happens. Let's see what the track record does as far as their fundamentals are concerned, and also what the price is telling me. So at the moment, if I want to be in that fast consumer type of good, I'd still rather stick with Shoprite until I'm very much convinced that in comparison, Boxer is possibly a better or an alternative to Shoprite.
Graeme, I want your take. We need to be quick because we've got to get to stock picks. But the thing I've done 100 times in my life is, like a stock, try get clever on the price and either pay up or don't get it in the end, because it never gets to my price. I mean, if you wanted Boxer, would you buy it at the current 64, or would you try be clever?
I can't tell you. I think it's a very competitive space. I think Shoprite are really good at what they do. They understand, the lower end of the market really well. They've obviously captured the imagination of the market. But, Shoprite's trading on a lofty multiple, but I would argue they deserve it. They've been doing it consistently for a long time, so I would agree with Ricus. But, there are quite a few other FMCG companies like Clicks and Dis-Chem that are also trading on lofty multiples, where the market's rewarding the management. So, we didn't participate in the listing, and my sense is I'd rather just wait and see what they deliver over the next while. Obviously, well placed, well run, but let's see what sort of numbers they deliver and what sort of multiple is then reasonable for that. When we've got a little bit more visibility.
Okay, let's go to some stock picks. Graeme, Körner, you're going with Coronation.
Yeah, I'm going with Coronation. So I think it's a fairly simple business model. If you look at the last AUM update, I think it was 667 billion rand. It's a big number. AUM has done very little over a decade, but they had such a big portion of the market in terms of the investable capital, third-party capital, that's probably sensible. But also, Simon, all of us know that the market has done virtually nothing for a long time. So it's not like you had, natural market momentum at your back. So for me, the bottom line is you're probably looking circa 4 rands worth of earnings. Pretty much all the earnings flow through. So what do I like? It has been a little bit of a kick up in AUM. If you look ever since the GNU markets are looking a lot more friendly. The cost base doesn't change awfully much, but if you get a 10, 20% kick in the market, then that just drops to the bottom line. But the other nice thing is we've signed today, you get a free pen that pretty much all the earnings flows through in dividends. But what I really liked was the recent move to increase their black ownership to 51%. I think that will help them secure new AUM. It could be a game changer, but it's really cheap, and it's a lot of those worries in terms of AUM shrinkage and the shifting sands in terms of the allocation to managers that weren't 51%. A lot of those, the tax issue, that's all gone. So in a way, you're getting compensated with cash-like returns, reasonable visibility, I would argue, on the short to medium term, with some optionality if the markets remain kind.
Yeah, no, nice stock. Ricus, Siemens, stock I haven't heard of in 100 years, and it is almost 200 years old. You're going back to old school.
No. Very much so, in a certain sense, if you think of Siemens as just a heavy industrial engineering company. A little bit more than that. They are very much involved in things like helping to build farms for AI and smart buildings and that kind of thing. So very much in the forefront of engineering technology. But just going back a little bit macro, if you compare something like Siemens, which is market construction engineering, the valuation of that being a European listed company but being multinational, as opposed to their US counterparts, it's heck of a cheap. So people are putting a discount on it because it's European. I think one should ignore that. Take a look at what the share price is doing, what they are doing. Share prices is actually breaking to new highs, and still, on a comparative valuation basis to the US, still damn cheap. Plus, then obviously the vector of growth, which is very much into not merely constructing and engineering stuff, but making it smart.
Yeah, no, I take a point. It's a great looking chart, bottom left, top right, all the way out. We'll leave that there for tonight's Stock Watch. Thanks to our guests, Ricus Reeders, PSG Holland 1 Ruimsig, going with Siemens, Graeme Körner from Körner Perspective, going with Coronation. Up next, the close. Stay tuned.